Okay, we can start. Okay, we'll continue. I hope is this, yeah, there we're functioning now. We continue with the story, which I said was a bit interrelated. And in the earlier this afternoon, we talked about the way Keynes looked upon the role of liquidity preference in his general theory. And I pointed out that at the end of chapter 17, he makes the comment that really the problems that are created by the rate of interest in producing a level of employment which is below full employment really didn't have anything to do with money per se, but had to do with the concept of liquidity preference, or what he called liquidity preference. And that is simply the disposition of the financial assets that are held in the system. As we said, liquidity preference tends to be something which people have either tended to ignore or not fully understand in the terms of the way Keynes conceived of it. And in one particular case, we said that the Hixian ISLM approach simply looked upon it as a rather strange reformulation of the Marshallian demand for money. And as we know, as I mentioned before, that particular representation is really very close to the quantity theory, which Keynes, in fact, had rejected. So this is a thing that he was trying to escape from in that book. And we also mentioned that in that book he makes reference to technical monetary detail, but does not go into great exploration of how he conceives of the monetary system. In fact, if you look at the treatise on money, the treatise on money starts out with a very long discussion of definitions of different types of money and the way money is used in the economy, with again the result that there is no straightforward definition that money is something. For example, if we look at the textbooks that we use in theories of money and banking, we have these functions which money satisfies, and we usually identify money by the things which satisfy those functions. Well, instead, Keynes talks about the impact that money has on the system. If you look again in the general theory, he talks about a monetary theory or a monetary theory of production as an economy in which, as we mentioned, the money has the characteristic of having a liquidity premium that's greater than its carrying cost, and that money that has that characteristic has the possibility of producing an equilibrium at less than full employment. So Keynes' definition is of a monetary economy is an economy that is has a possibility of equilibrium at less than full employment. Now, as I mentioned, those technical details are in the treatise on money, and they also come back when he discusses his proposals for the reform of the international financial architecture, which eventually produces Bretton Woods. So that if we want to have a good understanding of just exactly the monetary characteristics that Keynes had presumed in the general theory, we can find them, I think, quite easily by putting together or comparing the discussions in the treatise and the discussions in the formulation of Keynes' clearing union, which was, as I said, formulated as part of the Bretton Woods discussions. His proposal was not accepted. It was not accepted for a number of reasons. Day before yesterday, I suggested that one of the reasons was that there was a very strong pressure in order to create a supranational regulatory system based as close as it could possibly be on the gold standard. Now, Keynes had argued that the reform of the system should never be based on gold, that is, gold should be eliminated from the financial system. And in the end, what happened was that the discussions were such that in the final committee meeting before the final drafts were circulated, Dennis Robertson, on the result from, I believe it was one of the Indian delegates, volunteered that instead of having a unit of account for the system, that countries could in fact use gold as a substitute for US dollars. And gold in that way was brought back into the system in a rather surreptitious way. There's some question about whether Keynes knew that when he was signing the document that this had occurred or not, because as I mentioned, this took place in the discussions late at night and the night before the signing of the final agreements. The signing, which was done under great pressure because the reservation at the hotel that the U.S. government had made for the delegates was also due to run out. So they were trying to get the accord agreed in time so that they weren't thrown out. So basically what I'm going to do is to talk about the monetary bases of Keynes' clearing system, and then to suggest that although that proposal was rejected in the 1940s, that it probably is even more relevant today for a number of reasons concerning geopolitics, but also because of the fact of advanced digital transmission mechanisms. That is, we talk a lot about crypto and digital currencies. Well, we could engage in this clearing system on a digital basis, which would be much easier than it was in the time when Keynes originally proposed it. One of the interesting facts of this discussion is that an alternative proposal that was made by Schumacher at the time when Keynes was working on his own proposal formally declared that the proposal could be elaborated in a way in which no gold or national currencies would be required for its operation. Now, this is a very interesting aspect of the program. Why? Well, if you remember the discussions in the 1950s and the 1960s, and eventually the French complaint about the dollar dominating the international financial system, and a question which still prevails today, a proposal such as this one, which would provide for the elimination of the dollar as the key currency in the system, would bring about the possibility of eliminating a large number of political disputes in terms of the formulation of that system. The final advantage of this particular system is that it has an endogenous credit creation possibility that could be used for national development strategies, and that credit creation is in fact not international or global. It does not generate international indebtedness, but is represented by basic domestic indebtedness. Okay, so that's in summary what we're trying to do here. Now, just to start out with a little bit of fun, Keynes, of course, was involved in the final acceptance of what became Bretton Woods and participated in all the meetings shortly before he died. And one of the statements that he made as a representative of His Majesty's government at the final meeting presenting the Bretton Woods system was to saying that the delegates had gotten the names wrong. And this is a direct quotation from Keynes. I shall always hold to the view that the christening has been badly done and that the names of the twins should have been reversed. That is, that the fund should have been a bank and a bank should have been a fund. Now, what does he mean by that? What was the implications of this particular statement? So let's go back and ask the question, why was it called a fund to start with? Well, we know that Harry Dexter White, who was the major Treasury official who was responsible for the drafting of the United States proposal for the Bretton Woods system, had his initial experience working in the Treasury, working with the United States Exchange Stabilization Fund. Okay, the fund was created when? Well, Franklin Roosevelt eventually decided that the U.S. should go off the gold standard and suspended the dollar parity of gold with gold. Now, when you do that, and if you choose to devalue the currency, there is what accountants call a value adjustment. Okay, you have gold, which was previously worth X amount of dollars, is now worth Y amount of dollars. And the difference between X and Y has to be accounted for somewhere. You put it in simple terms, if the United States has one gold bar that was before worth $50, now it's going to have a value, which is, if the dollar has been devalued, a larger number of dollars. So somehow or other, magically, the US Treasury has a value adjustment in terms of these dollars. What are you going to do with them? They have to go somewhere. As you know, national parliaments always make a good make a good effort to do their assessment of accountings. And the result was to create what was called an exchange stabilization fund. And the exchange stabilization fund, which resulted from the dollar devaluation, was supposed to be used to intervene to stabilize the price of gold in terms of the US dollar. Now, it's rumored that this wasn't really necessary, according to the stories that circulated. The US dollar price of gold was determined every morning when Roosevelt's secretary went into his bedroom and asked him what he thought gold should be worth today. And he simply picked the number out of the air. Well, you don't need a stabilization fund if you have Franklin Roosevelt who's deciding what the price is going to be every day. Next point is that this exchange stabilization fund was largely patterned after the British exchange equalization account, which was created in 1932 when, guess what, the pound sterling went off gold. And exactly the same thing happened. Okay, so if you're looking at an international financial system and you're looking at how you're going to set up or to replace the gold standard system, what appeared to both the US and the British Treasury was that the sensible way to do this would be to create a, call it a fund, call it an account, something that you could use in order to intervene, in order to stabilize the price. Okay, and we can say basically these were price fixing arrangements. Now, those of you who are familiar with Milton Friedman's criticism of the eventual Bretton Woods standard system, his criticism always was that it was price fixing. That is, you were trying to stabilize the price against the forces of the market and that you would always fail. And this was one of his basic criticisms in support of moving towards flexible exchange rates, that is, simply allowing the dollar price of gold to fluctuate freely in the market. Well, if that happens, you really don't need a fund anymore. But the Bretton Woods system was eventually evolved on this idea that somehow or other the system should have exchange rate stability, that is, the gold price should be stable, and you did this by having a pot full of stuff which you used in order to stabilize the price. As Friedman commented at one point, not very respectfully, he said this was the same thing as trying to stabilize the price of pigs. Next question we want to answer: what is a bank? Okay, well, we now know that banks create liabilities that serve as means of payment. That is, they create purchasing power. From the end of the 19th century onwards, it was generally accepted that banks manufacture money. Okay, money is not given by the outstanding amount of gold. Money is created by the amount that banks choose to lend to their clients by creating bank liabilities. It's a very nice book by Hartley Withers in 1906, which makes the point that banks manufacture money. Now, I picked this because it's 1906, and this is peculiarly ancient in order to satisfy curiosity. There were writers even before Hartley Withers that talked about banks as being manufacturers of money. Okay, if we think about Schumpeter was always talking about the ability of banks to create money out of nothing. So this is the main idea of what we're looking at in terms of a bank. We now say bank loans create bank deposits. In the 1930s, Phillips wrote a whole book and trying to explain to bankers that they do in fact create money. Bankers, interestingly enough, always resisted this idea. They said, no, we don't create money when we create deposits because those deposits can go to some other bank. Well, you can see how short-sighted the bankers are, because if you look at the banking system as a whole, any money that goes from one bank ends up in another bank. And in fact, it cannot escape from the system. Once it's created, for the system as a whole, the money stays. May not stay on the books of the bankers who created the liabilities, but for the system as a whole, the bankers, as a banking system, do in fact have the ability to create money. It's very, as I say, it's very interesting. Philip's book was very influential in eventually convincing the bankers of this point. Now, whether the bankers were really that stupid or whether they were simply doing this in order to protect themselves from criticism from outside is a different story. But this is the way that things developed. So, in general, what happens in the banking system where banks create money? Well, banks hold reserves at the central bank. These reserves, well, we used to call them in the old days high-powered money. Minsky used to love high-powered money because his name was Hyman Philip Minsky, and he thought he was high-powered money, HPM. They held the reserves at the central bank to ensure that the deposits and the currency notes issued by the government or the central bank have a fixed exchange rate of 1-to-1. That $1 in bank deposits is always worth $1 worth of bank notes. And the banks assured this. Why? By holding bank reserves. You can sort of think of this as a fund if you like. But the main point is that the price of a deposit is always 1 unit of banknotes. Okay? And those banknotes are, at least in the case of the United States, after 1914, the notes issued by the Federal Reserve Bank in conjunction with the U.S. Treasury. Now, what looks like a bank is, well, let's think about Bretton Woods. The foreign exchange reserves held by the bankers at the central bank have an equivalent in the IMF quotas and the gold tranche, which the countries hold on deposits sort of as reserves with the Bretton Woods system, the IMF, and they use those reserves or those gold credits or tranches to stabilize exchange rates. So this principle of using reserves to stabilize a fixed rate holds good between the domestic private banking system and the central bank and the individual countries and the IMF. Now, the basic difference is that the IMF does not have the ability that private banks did to create additional credits. The entire fund is the deposit of gold and the quotas in foreign exchange that are held by the countries in the International Monetary Fund. So that these quotas, if you like, served as the fund that provided the foreign exchange swaps, but they were patterned after a bank, but without credit creation powers. And unfortunately, the IMF is still facing the difficulty of domestic resistance to increase their quotas. If you look at the discussions inside the board of the International Monetary Fund, the one thing you always find on its agenda is a proposal to increase the quotas. And you always find resistance from member states, and in particular the United States and the larger states, to oppose that quota restriction. Why? Because that quota restriction would then be the equivalent to increasing reserves or increasing purchasing power, creating new money. And again, we said the idea behind the IMF was that it would be, or it should be, in a sense, the equivalent of what Hayek believed to be the necessary banking policy, the equivalent of 100% reserve policy, in which the quantity of reserves or the quantity of currency was always fixed. This is what provided the constraint which imposed the market principle adjustment on individual countries. If we think of SDRs are in a sense a workaround to this outdated system of using quotas in order to create the reserves that are used by countries. So this is the basis of what Keynes was talking about. It says it looks more like a bank. It has reserves. It keeps a 1-to-1 ratio between exchange rates, But it has this one basic difference, and that one basic difference from a bank is that it does not have the ability to create additional purchasing power. Now, Keynes provided an alternative to this particular system, and that alternative was based on what Keynes called an analogy with a different domestic banking system. Okay, different domestic banking system. What does this mean? Aren't banking systems all the same? No, they're not. If we look at the work of Hyman Minsky, he talks about the various phases of financial institution organization. That is, financial institutions change over time. They change in response to the productive structure. For example, Minsky talks about the early period dominated by international trade. He says this is mercantile banking. Mercantile banking will be dominated by what? Well, the assets of a private banking system under a mercantile financial system are going to be basically trade bills. That is the financing of trade, rather than government deficits or the liabilities of private businesses. So that the structure of the banking system in England that we know of was built on the basis of what? Built on the basis of discount houses and a discount market. Why? Because it started out financing international trade in terms of foreign exchange bills, and those foreign exchange bills were discounted in the market. The US system was based on basically financing short-term specialist credit on the stock exchange. If you looked at the assets of the banking system in the United States from the middle to the end of the 1800s, their primary loans were loans to stockbrokers and to people speculating on the stock market in terms of what was called call money or overnight money. That is, this was lent on an overnight basis. Okay, so if you look at the structure of the balance sheets of the financial system, the structure is going to be different depending on how the national economy and its national productive structure is evolving. So Keynes said, fine, now Harry Dexter White, you've got your idea of the fund. Your fund is basically patterned on the way the United States financial system works, but that's not the way we work in Britain. And I have a system which is going to be patterned on the British system. Keynes suggested that that different system could be represented by what he called the banking principle. Now, the banking principle refers to something he called bank money in his treatise on money. If you read the beginning of the treatise, he has 10 or 15 different definitions of types of money that relate to different types of assets on the banking system and liabilities that are issued by the banking system. One of these is called bank money. Okay, what is bank money? Well, we can go back, or we can go as far back as Ricardo's essay on the economical and secure currency, or you can look at Jevon's book on money, which is equally instructive on this basis. And the interesting thing is that these things were also written 150 or 200 years before this particular discussion. Ricardo's essay on the economical and secure currency had already recognized, and this is a quote, the various operations of banking. And those various operations of banking he defined as the fact that money is merely written off one account and added to another. Payments could be made without the need for specie, that is physical gold, or paper notes, allowing a more economical mode of effecting our payments. Okay? There's a long literature debating on the evolution of the banking system in England. One of the things was whether the fact that paper notes substituted gold or not, because gold had an exchange value. Paper notes were simply good to burn and throw away. They had no relative intrinsic value. Okay? And normally the argument was that this was a bad thing. But Keynes obviously thought it was a good thing, and Ricardo thought it was a good thing, because he said this was a very economical mode of production. Interestingly enough, if you read Adam Smith was also in favor of paper notes, because he said using gold in order to finance work in progress and other things is a waste of capital. And if you manage to substitute them with gold, you've got more capital to expand your enterprise. That was Adam Smith. Okay. Keynes called this a bank money system, which depends on nothing except that the transference of the debt themselves is just as serviceable for the settlement of transactions as in the transfer of the money in terms of which they are expressed. Basically, what he says is that we don't need coins anymore. We don't need gold anymore. And we don't even need those nasty banknotes, which a number of people who were related to the dispute between the currency and the banking principle objected. He said, all you need is what? All you need is a banker and an account book, a balance sheet, a pen, and the ability to know the difference between assets and liabilities. See, the assets go on the left side, the liabilities go on the right side. Or is it the other way around? See, that's why I'm not a banker. Because if you get them mixed up, you're in big trouble. There's no need for gold, no need for banknotes. They did not even physically circulate, and they were simply inscribed in the banker's account books and clients' balance sheets. The bankers circulated the bank money by debiting and crediting the client's accounts. Now, the other thing is that, as we know, after knowing the difference between assets on the left side and debits on or credits on the left side and debits, I keep getting mixed up. Knowing the difference between the debits and the credits, you also have to have a common unit of account because you have to be matching debits and credits all the time. So for this system to work, you need a unit of account, and that unit of account can be, indeed it is, purely notional. Okay, when the accountants keep the company books, they don't take little gold tokens and move them from the right side to the left side of the balance sheet. They simply say, oh, I have a thing in my brain that represents the units that I am inscribing in my books. And my books are fine as long as that unit doesn't change. If it does change, then we are in difficulty. And we'll see in a minute why. So this is our banking principle. Now, if we ask the question, what is the banking principle at the global level? Okay, obviously you need a global banker. Keep a global balance sheet to do debits and credits. Who are the clients? Well, probably the clients are going to be either big national trading houses, or eventually, when countries get around to forming national banks, they're the national banks or the currency authorities of the various nation states. What are the debit and credit entries on the country account on the balance sheet? Well, we know from studying our international accounts, we talked about these problems raised by frontiers in terms of your current account balance. The current account balance is going to have an external balance in terms of national currency. Exports create credits, imports create debits, or vice versa if you want to do it that way. The interesting thing about it is it doesn't make any difference. You just have to be consistent in terms of the way you do it. And you must have that common unit of account. Fixed exchange rates have to meet the principle that credits can always be used to extinguish debits. Why? Because you have to be able to convert those credits into debits without dispute and without market intervention. This is why this is implicitly a fixed exchange rate system. Just as the gold standard value of the unit of account in national currency is fixed by national governments, that is, if we think of the gold standard, what did the National Monetary Authority do under the gold standard? The only thing it had to do was to create the weight in gold in the national unit of account. That's it. Once they had done this, they could go to the beach and stay there forever. They didn't have to undertake any sort of formal action. Same thing would be true here. As long as the government or the central bank fixed the rate of exchange between the various national currencies or It established the national currencies in terms of a single global unit of account. The national monetary authorities could go home or go to the beach. All they had to do was to send their accounts to the global bookkeeper. And the global bookkeeper could do exactly the same thing that the central bank did when Ricardo noticed that almost all transactions were engaged in terms of the bankers entering credits and debits on their accounts. This is the proposal that Keynes made when he said, all I'm doing is replicating a national banking system on the global level. So you can see the difference between Bretton Woods, replicating the sort of US reserve loans creates deposit system, and Keynes simply replicating the British system in which you have the central bank monitoring the private bankers who are using debits and credits in order to finance and inscribe transactions on the balance sheet. So Keynes' proposal, his clearing union proposal, is a global bookkeeper. It's based, as he said, on the necessary equality of credits and debits, of assets and liabilities. If no credits can be removed outside the clearing system, and obviously they can't because those credits are all on the books of that single global bookkeeper, but only transferred within it, it can with safety make what advances it wishes to any of its members with the assurance that the proceeds can only be transferred to the clearing account of another member. Okay, now this is extremely interesting. It says that it can make advances it wishes, any advances it wishes. Any advances it wishes means what? It can create purchasing power. Schumpeter must be sitting there inside the bookkeeper saying, I've discovered how we make money out of nothing. We simply make money by making a debit and a credit entry. That's how we do this. And the amazing thing is the credits and debits will always balance. And worst of all, you can't have a credit crisis when everybody takes their pesos and deposits them in New York, because now they're all deposited in this central system and they can't get out. Okay. Now, the only problem is for the central banking or the central global bookkeeper to make sure that its members keep the rules and that the advances made to each of them are prudent and advisable. Okay, this is simply prudent banking policy. Okay, due diligence at the national level. No physical money, no prudential reserves, no collateral are necessary. Keynes even goes so far as to say you don't even need bank capital for this type of system. Why? Because, and Ricardo already saw this, by the way, because as he pointed out, there can't be any losses. The assets always equal the liabilities in this system. Okay? Only a common national unit of account is necessary to keep the books. Now, I should say as a caveat, this requires doing due diligence on a national level. Okay? If you've got crooks, if you've got fraudsters, if you've got people who are not obeying the rules of the system, obviously assets and liabilities may not continue to balance. And then you do have, or you have potentially, difficulty. Now, if you look at the formal organization of this sort of system, you can think of it this way, that countries, nation states, are holding accounts on a global balance sheet. The analogy with a national banking system is complete. No depositor in a local bank suffers because the balances which he leaves idle are employed to finance the business of someone else. Just as the development of national banking systems served to offset a deflationary pressure which would have prevented otherwise the development of modern industry, so by extending the same principle to the international field, we may hope to offset the contractionist pressure present under the gold standard. Okay, what he's saying is that now, if you put money in the bank and you leave it there, okay, what does the bank do on a national banking system or this British banking principle system? It's not that the bank says the money stays there and nobody does anything with it. They transfer it to somebody else who wants to borrow it. Okay, and he says, you don't worry by the fact that you have a positive banking balance that you're financing the negative banking balance of somebody who has borrowed from the bank. Okay, why should you worry about this? But under the international system, under the Bretton Woods system, if you have a balance of payments deficit and you have to go to the IMF in order to swap your domestic currency for foreign currency, you've acquired a debt, and you've acquired a debt that you have to pay back, so that you are a debtor and there is a foreign creditor. And if we think, well, if you think of the current common market, the relationships under the crisis in Greece, when Germany was the major creditor and Greece was the major debtor under the EMS, European monetary system, the Germans were very nervous that the Greeks would default. They would never pay back. You're saying in this sort of system, you don't have that problem. So this was Keynes' alternative for patterning the financial system on the British system, what was basically called the overdraft system, and it was the basis for his clearing union proposal. It wasn't something strange. It wasn't something out of character. It was something that he knew very well. Now, the interesting thing is it does not require a global currency. Okay, all it needs is that global unit of account, so that you don't have, well, what don't you have? You don't have international banks operating foreign currency markets, borrowing and lending, speculating in terms of foreign currency. You can't speculate against an imaginary unit of account. You can't even get a hold of the imaginary unit of account if you're a private banker, because all those debits and credits, where are they? They're on that global balance sheet, which you don't have access to. It's only the national central banks that have access to that. Now, as I've already mentioned, there was at a stage a question of naming this unit of account, this imaginary unit. Could be called Unitas, it could be called Bancor. There were all sorts of names that were floating around. Okay? But you didn't need a physical representation. In fact, you could simply use the language unit of account, as long as that unit of account was specified in terms of units related to the national currency units. It's very interesting if you think of it this way. If you look at international time, okay, we have Greenwich Mean Time, and we have Central Standard Time, and we have Mountain Time, and we have all of these times. If you fly in an airplane, if you're a pilot, or if you look at anything else, what sort of time do you use? Well, these are these universal time units. Okay, they're not anything physical, they're just a name. Universal time. It is simply a name. And this is the same thing that would have prevailed under this time system. It also provides for unlimited finance for global trade and domestic investment. Why is this true? Well, as long as every country that's having a surplus or every country that's having a deficit is automatically getting a compensated debit or credit inside the system, technically, there is really no limit to the amount of trade that you could finance with this sort of system. The same thing is true, incidentally, of a national system. Now, for Keynes, the major benefit of this was that it avoided what he called asymmetric adjustment under the gold standard. What was asymmetric adjustment under the gold standard? Well, it was that thing that Mises and Hayek and Friedman always thought was the good part of the gold standard. That is, that the debtors, when they couldn't pay back, had to tighten their belts, restrict their expenditures in order to make their payments on the existing debts. And Keynes says, no, that's what we want to get rid of. That's what we want to avoid. And this is, again, back to that discussion that we had on the first day of the approach of the neoliberals, who looked upon these sorts of systems as market system constraints, extra national legal constraints that national governments could not abrogate. That is, the national government could not say, well, we don't want to have a recession just in order to pay back the Germans, so let's simply abolish the system. Let's vote against the fixed exchange rate. Let's change the way we work. Okay? Now, Bretton Woods system basically maintained that asymmetric adjustment that you had under the gold standard with a certain amount of leeway. And what was that leeway? Well, the leeway was that if you got into difficulty and you couldn't maintain your fixed exchange rate with the amount of quota and gold tranche that you had on deposit with the IMF would come in and help you out. They would help you out by giving you a bridge loan, and that bridge loan was conditional on introducing what we now call austerity policies in order to generate a sufficiently large external surplus in order to repay the money that you had borrowed from the IMF. The IMF became the equivalent of the neoliberals' extra national or supranational regulatory system for making sure that the principles of private property and debt repayment were always satisfied. Now, if we look at Schumacher's idea of pool clearing in a slightly more detailed way to understand how you might develop this system, which in fact did not need a national currency at its center. And as I said, this is one of the major advantages that you have in this clearing system is that, number one, you don't need a national currency. And number two, you don't need to depend on that national currency in order to generate the financing which is required for countries to grow at a rate which is more rapid than stability on its external balances. I mean, the interesting thing, well, we'll get to this in a moment. Okay, Schumacher proposes a system of pool clearing in which importers settle their claims for payment of imports in their national currency by transferring to their own national clearing fund. Okay, so you buy something from Britain, you need to pay sterling, you don't have sterling, you've got pesos or dollars, you transfer those pesos or dollars to your national clearing fund. Okay, this is great for you. You don't have to worry about foreign currency or anything else. National Clearing House enters it on the national fund. They inform the exporter's national currency fund, and the national currency fund of the exporter pays the exporter in his national currency. Okay, so the importer pays dollars or pesos into his national fund. The sterling national fund pays the exporter sterling. Okay, now if any of you know how foreign exchange markets have always worked, this is the basic principle that they have always used. All Schumacher was doing was replicating what private bankers already did under the gold standard in the 19th century. In order to stabilize exchange markets. Okay, so this is the first step. The clearing fund accounts of the deficit countries, of course, will have surplus accumulation of national currency. Okay, if your guys are buying too much stuff from Britain, you're paying too many dollars, your national currency fund has a whole lot of dollars there. What are they going to do with those dollars? He said you invest them in domestic treasury bills. Okay, you keep the money, you put them into treasury bills. Same thing is going to occur on the other side, so that the pooling of balances arises automatically, and an international clearing office is then created to act as the trustee of the accumulated treasury bills in the clearing funds of the deficit countries. So you've got all these countries, they all have national clearing funds. National clearing funds have accounts with the global clearing fund. The global clearing fund holds the government paper, if you like, the treasury bills of the deficit country. In this way, the clearing funds of the surplus countries are effectively owners of a pro rata share in the pool, which is equal to the size of the surplus. Now, the interesting point is that Schumacher did this in order to ensure multilateral clearing. That is, to avoid having to balance debits and credits across countries, which is what happens today in terms of private sector financial flows. It's always a private country lending to another, or sorry, the private banks in one country lending to either private banks or a government of another country. So these are always bilateral. The important point here, as he said, is that they are multilateral. What, again, if you take the example of Germany, Germany had a share in the pool of treasury assets from the other members, and it would be not only the Greeks, but also the Italians and the Portuguese and the French and everybody else. Now, if you do financial analysis, what does this represent to you? This is a diversified portfolio. Okay, Germany is much better off holding a diversified portfolio of assets in other countries than it is simply holding Greek paper. Okay, so there is a risk reduction here. Now, as Schumacher goes on to argue, it would be clear that the International Clearing Office requires no finance of its own. That is, it doesn't have to spend any money to buy these treasury currency, treasury securities. They're donated or transferred by the national clearing funds, nor does it have to create a new international currency. What do you need a new national currency for? You've simply got all of these treasury bills sitting there in the fund, and the various countries have pro rata shares, plus or minus, in those funds. Since it is impossible to disentangle the mass of individual transactions which give rise during the course of annual trading to the various uncleared balances in the deficit countries, and to ascribe them to any one particular balance or part of it to any one particular surplus country, the surplus countries as a group become the joint owners of the balances in all the deficit countries. Okay? Now, if you were here the day before yesterday, remember Rosenstein-Rodin? Sort of looks like the same thing. What you're doing is working on a pooling of risks and a grouping of multilateral responsibility. In this sort of system, what happens? Well, every national currency is in fact a world currency because it finances for domestic residents purchases in any international currency, because you're always paying in your own domestic currency. You can buy anything from any country you want to by means of a deposit of your domestic currency into your national clearing fund. Nor does the International Clearing Office require any special powers. It's not an agency for control. It doesn't control anything, but it's purely an administrative body, something like what the BIS was supposed to do in the beginning when it was parceling out the gold from Nazi Germany. The central accounting office for the different clearing funds. The clearing funds of the surplus countries become indebted to their internal money markets and acquire an equivalent share in the pool, both their debt and their share in the pool being equal to the trade surplus. Clearing funds of the deficit countries are left with balances of cash in hand equal to their trade deficits, which belong to the international pool. Finally, the clearing funds of countries whose balance of the trade has left neither surplus nor deficit have neither cash nor a share in the pool. They come out even. Now, the interesting thing is that if you look at the Bretton Woods system, okay, the Bretton Woods system is based on the presumption that over time, all countries will in fact come out even. Okay? If your exchange rate is fixed and you have a fixed given amount of reserves, as soon as your exchange rate departs from the fixed stable value, you start losing your reserves. As the currency depreciates, what happens? Your reserves end up disappearing, as your current account deficit increases. Eventually, you reach a point when you no longer have reserves. You go to the IMF, and what does the IMF tell you? You've got to get your external balance into not only into equilibrium, first you've got to get it into surplus. And eventually, after you've got it into surplus, so you can pay us back the money we're lending you for the bridge loan, then you're going to go back to equilibrium. The stable position for a Bretton Woods international financial system is everybody has an equilibrated external account. Now, the interesting point about this is that when we talk about development strategies, what do we argue? Well, we say we have development strategy based on what? Transferring savings from developed to developing countries. Those are capital transfers. What do capital transfers do to your external accounts? Well, your current account is simply the mirror image of the capital account. If you have financial inflows, your capital account surplus is going to produce a current account deficit. So that by definition, what is the Bretton Woods system doing? It's intervening to make sure that you never have a development strategy that exceeds the amount of growth which allows your external balance to go into deficit by the amount of your domestic foreign exchange reserves and your ability to access your quota in the IMF. The IMF is in particular managing countries' development strategies in this basis. And this is what the neoliberals wanted. This is what they thought was supposed to happen, only they thought the gold standard could do it much more efficiently than that. Okay? If we look at the bottom line of Shoemaker's system, he points out that these clearing pools assets are always in the weakest currencies of the world. Okay? There is a risk associated with those pro rata shares that you have in the treasury securities of these deficit countries. The currencies of the countries that have been unable to earn as much as they have spent. Note that this provides a strong incentive for surplus countries to take action to spend their balances. Okay, get some goods before these countries default, automatically improving the risk characteristics of their holdings. So that the other benefit of this sort of system is that it creates an internal incentive for people to unload those surpluses, because there is always a risk that those surpluses are going to be lost if the country chooses to unilaterally devalue its currency relative to the unit of account which is specified for the global financial system. Okay, so this is the problem that, well, not the problem, that this is the benefit that you might have in this sort of financial system that you have in terms of Bretton Woods, and it does provide an alternative. Now, for a number of people who listen to this, you say, well, now how is it possible for this system to domestically create credit? Okay, well, I'd like to use a very simple example. Okay, let's assume that we're all part of a club, or let's assume we're all part of an economy. Okay, and we're all subject to division of labor. Okay, we specialize. So all of us need something from somebody else. Okay, how are we going to go about doing this? Well, you're going to go to the persons who have the inputs that you need to produce your outputs, and you say, I need your well, let's take a very popular import recently, lithium. Okay, I need your lithium. And you say, okay, yeah, you can get the lithium. How are you going to pay for it? You say, I'll write you an IOU. Binsky always used to say, creating money is easy. You just write an IOU. You have to get people to accept it. You say, okay, I'll write you an IOU. The lithium producer says, well, okay, that's fun, but why should I take this from you? He said, well, you're a lithium producer. To produce lithium, you need a lot of heavy equipment, right? Well, it just happens that country C over there produces a lot of heavy equipment, and you're going to have to buy heavy equipment from them. What are you going to use to pay for that heavy equipment? You go, oh, well, I can give them lithium. You say, no, but we know that bilateral trade is not efficient. What we can do is we can create our bookkeeper. And the bookkeeper is going to give you an account and to give me an account. I have now a debit with you. You have a credit with me. You trade with country C. You get your heavy capital equipment. Now you've got a debit, and country C has got a credit. And we keep going around in a circle. And eventually, you ask the question, why are you willing to accept those promises to pay? Willing to accept those credits? You say, well, I'm willing to accept those credits because I can use those credits in order to discharge my debits, to discharge the debts that I have for the things I have to buy. So the system holds together. Why? Not because you have gold that has value, not because you have banknotes that represent gold. The system holds together because everybody has debits and credits relative to everybody else. And as long as those credits can be used in order to discharge your debts with other people in the system, you're willing to hold them. And all you need is somebody to organize this system, and that's our bookkeeper. And you need your bookkeeper, you need your unit of account. Now, when you get to that point, say, okay, what if we want to create credit in this sort of system? Well, that's easy. Let's make me the bookkeeper. Make me the bookkeeper, and you say, well, I need to expand my business. You say, I've read Schumpeter. Schumpeter says that I can get money out of nothing from a banker, and he's going to allow me to access resources that I can use to introduce new technology. And I can say, yep, I'm the E4 of capitalism, which is what Schumpeter called the banker. All I do is I write up your account by giving you a credit. And you use that credit in order to acquire the inputs that you need for your new innovations. We've now discovered how Schumpeter looked at this process. Schumpeter was very clever. He never formally described the way bankers work, or at least he never described it in the theory of economic development. When he wrote Business Cycles, well, then he made more stories than one about how you could go about doing this. Okay, but the point is that in this sort of system, you always have the possibility of increasing your purchasing power by means of writing up your debits and credits. There's no limit, okay? There's no quantity of money limit. You never run out of money. What do you run out of? Well, you might run out of lithium. Okay, the limit on the system is the physical resources, the physical productive activity that you have. This is why I said before, due diligence is important. Okay, because if you've got a bunch of fraudsters in the system and says, okay, I'm increasing my credits in order to buy some lithium, and in fact, I'm simply going to the track and betting on the horses, then you've got credits and debits that don't match up, or eventually they won't match up. Okay, the system might have difficulties. So that's why you need the due diligence. And as you said, there's never been a financial system that didn't exist without due diligence. Sometimes it works, sometimes it doesn't. Very interesting that these sorts of local systems can be either local or they can be regional or they could be global. There's no reason why we can't have a system based on, well, just us. And there's no reason why you can't have it at a global level. Normally, the difficulty, which is represented by the so-called balance of payments constraints, as we said before, is the result of what? It's the result of these borders. It is not really the result of the borders. Think of it this way. If we've got our group and I've got a bunch of credits here, and I've borrowed something from César, or I bought something from César, I'm using my credits in order to extinguish my debt to him. What if I want to buy something from, well, somebody who's not part of the group? I go to somebody who's not part of the group and I say, okay, I want to import. And I'll pay you with a credit that I've gotten from selling something to Arturo. And I say, Arturo? Arturo who? Arturo what? A credit from Arturo? He's not part of my payments group. He's part of your payments group. Okay? A credit on Arturo is good here, but it's not good on the other side of the border. Okay? And that's where you end up, number one, with foreign exchange. That's where you end up with your external balance. And that's when you end up with, the need for some sort of meta clearing system that combines all of these individual systems. Now, whether they're national, whether they're regional, whether they're local, they all function in exactly the same way. And Keynes' point was that if that system functioned very well for a national banking system based on the banking principle, it should work very well for the global system as well. Now, it's interesting that if we look at, we've already talked about that. And we've talked about that. It's interesting that the first example of these things, after they were rejected in 1944 in Bretton Woods, in the European Recovery Program, the first thing that was introduced was what? The European Payments Union. What was the European Payments Union? It was a clearing system. It was not identical to the one that Keynes proposed, but it was very, very similar. And it turned out to be extremely successful. Extremely successful until what happened? The Brits pulled out. Okay? They're always Brexiting, these guys. They couldn't stand staying in the system because basically it was going to the benefit of the entire European community relative to Britain. And they decided Britain would be better off on its own. Okay? But you had the example of this. In addition, if you look at the post-war period, multilateral clearing and credit arrangements amongst developing countries. There are not hundreds of them, but there are tens of them, or 15ths of them, or 20ths of them. There are a whole lot of them. Latin America, Central America Clearing Union, Latin American Integration Association, CARICOM, West African Clearinghouse, Grand Lakes Economic Community Monetary Arrangement. You ever heard of that one? Okay, Burundi, Rwanda, and Zaire. Okay, they were all over. I mean, this was a thing in the post-war period. And it was a thing, strangely enough, that we never managed to adopt on the global level. We went around providing all of these regional proposals. You had them in Asia, Regional Cooperation for Development, Union for Multilateral Payments Arrangements, 1967, Iran, Pakistan, and Turkey, Asian Clearing Union, Bangladesh, Burma, India, Iran, Nepal, Pakistan, and Sri Lanka. Okay? History is like a book, and you open it and you discover these amazing things that nobody ever knew happened. But these things did happen. And whether they existed or didn't exist, succeeded or didn't, this was something which was given as a possibility for financing development strategies. The question is now, why consider the clearing union now? Okay. Well, the first thing is we do have a problem of funding. Okay, and we probably have a problem of funding, not only the problem of funding development for developing countries, but we have the problem of environmental and climate difficulties. That is, funding of the reparations which are due to the damage of climate. And secondly, the introduction of new methods for energy conservation and utilization. Where's the money going to come from? Okay, this is clearly a global issue. It's not a national issue. Just as Rosenstein Rodin said, no particular government would be interested in funding or financing the Big Bang. No individual government is interested in funding climate change on its own. But if you do it on a global level and you use risk sharing, it is a much more viable proposition. The second point is that we now do have the advanced technology for these global bookkeepers. Okay, what is blockchain? What is this distributed ledger? Well, gosh, the techie guys simply reinvented bookkeepers. That's really boring. Bookkeepers are supposed to be the most boring thing in the world. You used to, when I went to university, you had to take an obligatory 2 semesters of accounting. That was the thing which prevented most people from graduating. Accounting is very difficult and it's very boring. But now we have these blockchain guys, and apparently people love it. They think it's great. So we have the possibility of creating this global clearing union on the basis of the blockchain. Most central banks are contemplating a notional digital unit of account, these famous CBDCs. It sounds like a pop group. Central bank digital currencies. Okay, I got CBDCs. We've got to have them because that's the best thing on the block. Okay, if you look, virtually every central bank has a proposal for CBDCs. Well, instead of having a CBDC, what could you have? You could have this national clearing fund based on a blockchain. It would be almost the same thing. Okay, these CBDCs, central banks don't like them. Central bankers don't like them because they say, there's nothing different than what we're doing now. Or they're either too complicated and we don't know how to do it. Okay, there's this problem of latency in terms of a CBDC system. If you manage this, the Federal Reserve had to manage every account of every individual in the U.S. financial system operated by the private banks. And we know already that the Social Security system can't run a computer. We know that the Internal Revenue system can't run a computer. We also know that the immigration system in the US can't run a computer. Why in the world should we believe that the Federal Reserve is going to be able to introduce an IT system which is going to be able to manage all of these transactions around the blockchain? It's already the case that if you do a transaction in Bitcoin across the blockchain, you can't get a transaction done in less than 15 seconds. Sometimes it can be 15 or 20 minutes. Okay, that's not the way the system, they believe the system will function. So technically, people are already looking at this, but it would be much easier to link these CBDCs together. Instead of having everybody doing their own, let's have everybody do it the same way. Let's have everybody do it in a clearing system. Okay. So basically, what most banks are doing, and the Federal Reserve in particular, is saying since we don't have the technical capabilities and capacity, and particularly we don't have the money from the Congress to do this, what we're going to do is to create digital reserve accounts. Okay, the reserve accounts that banks have currently with the central bank will become digital. And a dummy like me asked the question, you mean today that the private banks pick up dollar bills and go to the local district Federal Reserve and deposit their reserves in physical money? No, they make digital transfers. And I go, oh, so you're already doing this. There's no difference between creating a digital reserve account and the reserve accounts that you have. The only difference is that the banks, okay, now are going to be able to offer digital accounts to their clients. So that the private bank that has a CBDC account will offer a share in a CBDC account to their clients. And the clients can use them. And you say, big deal. I already do that. I don't have to have a special account to do that. I do everything in terms of digital transfer. Okay. Now, so it's in that sense, it's not a big deal, but it is a big deal that if you do go basically to this idea of digital reserve accounts, it means you're bringing back 100% reserve banking. Okay? The private banks cannot any longer create money if they're limited to the amount of CBDC that they can pass on to their clients. So this becomes what looks very much like what, again, our neoliberal friends were trying to introduce of saying eliminating the possibility of active monetary policy. Friedman would look at this and say, yeah, that's a good idea. This is what we should be doing. Because now all you do is you limit the amount of CBDCs and you're back to my 1948, 1968 proposals. They would work. Okay? And this is basically what IIEc wanted to do in terms of national bank. Now, all of these changes would be facilitated by a simple clearing arrangement. Now, the interesting point is that there is already a private system like this that already exists, that uses the shoemaker system, which is called WebTelMobi. I've written a couple of things about this. Why? Because the people who were running WebTelMobi had looked at a number of things I had written on this clearing arrangement. And they wrote to me and said, well, it's very interesting that you discovered what we're already doing. And I wrote back and I said, well, I didn't discover what you're already doing. I mean, we've known this for 300 or 400 years. And the people who were running WebTelMobi said, yes, that's exactly the point. What we are trying to do is to create a system by which every individual in the country has an entry on a global balance sheet. All of the transactions are undertaken by means of debits and credits. They're all undertaken in terms of their national currencies. If they choose to convert to foreign currencies, they can always do this by entering into a swap arrangement on the system. You get a debit credit here, debit credit there, and your dollar balances have been converted into peso balances. And you can consider this system as what? Consider a system in which it converts your national currency into a global currency, because you can make a payment by means of using a credit in your national currency to discharge a debit in any international currency. It's a system where debits and credits always balance. Okay, we know that has to be the case. So that basically the system provides for the kind of stability that is required, as long as what? Well, as long as you have a basic system of due diligence. And the interesting thing is that this system is not one similar to what we talk about in terms of digital currencies. Anybody can have them. No, they have a due diligence system in terms of a KYC system, which is an amalgamation of every KYC system, of every financial system in the world. So once you're accredited into this global system, you've satisfied the Know Your Client recommendations and the AML regulations. So those are anti-money laundering regulations that are in vigor in every country in the world. And once you've done that, as they say, the system becomes perfectly safe. Now, the final trick of this system is what? That it does work on that reserve balance system. Okay? When you're transferring your dollars and you're making a payment someplace else to create a debit or a credit inside the system, what does the WebTelMobi computer do? It deposits your funds on a regulated banking account. Okay? There's a one-to-one balance between your credits in the clearing system and your credits in the regulated financial system. So the argument behind this is that it cannot fail unless the creators of the system take their money and go to Brazil. And recently, Brazil has not been that great a place to be, so they may not do that. Okay, so you've set up a system. The private sector has already set up this system, which is precisely the system, and should not be a surprise. I mean, when I saw the system, they explained to me how this system works, and I said, Keynes did that. He knew that. He knew that that's how the system was supposed to work. And what he wanted to do was to make it global. It's just that nobody was willing to do that. You're the first people that I've seen that have been able to do that. Okay. There are all sorts of foreign exchange trading systems. Okay. There was a system in Estonia. These guys were very clever. They said, we're going to give you foreign exchange at cheaper prices and much more rapid than everything else. So I teach every once in a while in Estonia. I went to talk to these people. Okay, how does your system work? Basically, it was just the shoemaker system. They said, we take your deposit in sterling, and what we do is we match it up. If you've got a debit in sterling, we match it up with somebody in England who has a credit in sterling. And that's all we do. We don't transmit the funds. As I said before, bankers never transmitted funds in international foreign exchange markets. All you did was to match up debits and credits domestically. When they didn't match, what did you do? Well, you borrowed. Okay. The banker would borrow some credits if you came up short, or they would issue some debits if you were long on the system. You didn't in fact, have to move the system. You didn't need the digital specification. So this was supposedly a digital system. Okay. So this is the argument that we end up with, which says that if you take seriously Keynes' idea that liquidity preference means that you don't need money, there is also a banking system which says that you don't need money. For example, if you have one of these WebTel accounts, on that WebTel account, you have a credit. You can use those credits to discharge any debt that you want any place in the world. No physical money takes place. You don't have any physical money anymore. You have a system which has no money. So if you think of these things as saying what Keynes did was that you have a no commodity money system, but what you do have is a clearing system. If you look at the operation of the US financial system before the Federal Reserve, how did it work? It worked on the basis of regional clearinghouses. That is, the banks got together and set up the clearinghouses themselves. The New York clearinghouse handled all of the payments for New York City. The Chicago clearinghouse handled all of the payments for Chicago, and so on for the rest of the system. Okay, so we'll stop at this stage since I'm sort of tired. We've been going long today, but you can see, or hopefully you can see, where this fits in. Okay, in terms of what we were talking about yesterday and the day before. This is the kind of financial system that Keynes had in the back of his mind, the technical system that he had. You can read about it in the beginning of the Treatise on Money if you want to know more. And this is the kind of system which operates, as we said, without the necessity of that external constraint that we have in terms of the Bretton Woods system. If you were going to have, and Keynes argued in this way, if you wanted to finance developing countries, if you wanted to transfer resources from developed to developing countries, how could you do it? Well, you could simply place taxes and subsidies on account balances. So if your surplus account balance went over a particular limit, you would have to pay a surcharge. It would be a surcharge because you didn't spend it, basically. Okay, and you could use those funds to do what? To top up the accounts of developing countries, so that you could write down their debit balances by means of the transaction taxes or whatever you want to use on the credit balances. This is the way you could provide for an automatic transfer of funding, development financing, without creating bilateral debit credit relationships and without creating the necessity of debt defaults, because these transfers would be as we said, transfers. That is, they would be what the original United Nations system meant to do was grants to developing countries, grants and pledges to developing countries. They would not have to be paid back. And the question is, would the developed countries, the surplus countries, be willing to do this? Can you think of the answer to that? Well, you already pay for your bank account in most countries. So this is simply paying for participation in this global system. Without this global system, if you're a surplus country, would you be able to have an export surplus? No. So simply, this is the charge of carrying those export surpluses on the financial clearing system. And if they're willing to participate in the system on that basis, then they're also willing to participate in the transfer. And just as a closer, this was always Prebisch's argument for developed countries providing concessionary finance to developed countries. Because if you're a developed country and you've got a large export surplus, you depend on somebody to buy that surplus. Who's buying that surplus from you? Oh, it's the deficit countries. If we're going to whip these guys and prevent them from buying because they've bought too much, that means what? That means we're going to reduce the amount you can sell. And this is the other thing, as I mentioned, that Prebisch understood, but also that the clearing mechanism makes very, very clear that in a global interdependent trading system, everybody depends on everybody else. Okay? It's not that the surplus country can get its money back by imposing austerity on the developing countries. They're going to lose at the same time because they're going to lose part of their markets, they're going to lose part of their income, and they're going to lose part of their export surplus. Okay, let's stop there. And I promise tomorrow we will do crypto, which will be lots of fun. Yep, sure.
Okay, so the Bretton Woods system, international monetary system, was I don't know, instaurated right after the Second World War, right? Like a new system, like with all these reforms and I don't know, better technology and all of that, would be I don't know possible to implement in the current conditions of the world? Or what will it take to implement a reform of the current international system, monetary international system?
Okay, this is always the question that you get. You say, it's too difficult to do anything, so let's not do anything. Oh,
I mean,
okay, you try and find a response to that question. The first response that you get is technology. Okay, technology has far surpassed now the way we operate the traditional financial system. Okay, what you call TradFi. Okay, the thing simply, as the argument goes with the crypto people, it does not work. Well, it's not that it doesn't work, but it's particularly outdated. Okay, if you look at the way the U.S. system settles debits and credits, it's just it's hallucinatory. Okay, if you would you hardly ever write a check anymore, but they still use checks. If you write a check, to the recipient takes it to its bank, the bank sends it to your bank to get verified, your bank sends it to the Federal Reserve, the Federal Reserve then sends it back to their bank, and then you get the credit. Okay, instead of having a direct gyro system of payment. Okay, this was always the complaint that people had. You would go to Europe, Americans would go to Europe and say, open a bank account and say, where's my checkbook? I say, what do you mean, where's your checkbook? You don't need a check. What we do is we give you a little chit and we said, we'll transfer X to bank Y directly. You don't need to write a check. You don't need clearing. You don't need anything else. It just goes directly. Okay. Now, all of those things you can do with technology. And basically, what usually happens is that the new technology, as Schumpeter told us, drives out the old technology. Okay. We've been through this several times, right? Remember, there was a thing in the old days in the U.S. called AT&T. AT&T had a quasi-monopoly on the telephone system. New technology entered into the system. What happened? The government went to work and said, AT&T has a monopoly. We're going to break down the monopoly and get rid of the ability of AT&T to control the system. And then all of a sudden, everybody said, but gosh, see, we've got these mobile phones. Nobody needs AT&T anymore. Nobody needs to break up the system. We now have a completely different method of transmitting. Okay? It's a fixed line system. It's a fixed tower system. What's the difference? Well, the difference is that one obviously has a net advantage to the other. Okay, with your fixed line, you can't carry it with you. With a fixed tower system, you carry the phone with you and it displaces the old fixed line system. In the United States now, I think something like only 15 or 25% of the households still maintain a fixed line telephone system. Okay, now you could have started out by saying, oh, no, we can't, how can we implement that system? It's going to take a lot of money in order to build all of these transmission towers and to build all the technology and everything else. Well, that's the way the system functions. Microsoft haven't had a monopoly on the operating systems. What happened to that monopoly on the operating system? All of a sudden, Apple came along. Oh, well, Microsoft is not doing so well anymore. The new technology blew it away. And this is a case, and the argument that I'm making here is that it's the technology that we've got that makes the clearing union much more attractive than it was before. Okay, you can do it very easily. You can do it at minimal cost, and you've got people doing all sorts of things. That's the first thing. The second is that you do have these, well, what we were talking about day before yesterday, national boundary problems. And that's the single currency problem. Why is the dollar the center of the international financial system? Does it need to be? Does it give a benefit to the U.S. or is it a detriment to the U.S.? You have people who argue on both sides. Well, here's a system which says that we don't need to do it that way. Okay, you don't have to have a national currency. Okay, having a national currency is the equivalent to the argument that says gold is always going to be the best money that you can have in a financial system. Why? Because it's very high value to weight, it's malleable, it holds up very well, and it has high value and all of this nonsense, which says that it's going to be the single thing which is used as the center of reducing the n minus 1 over n plus 1 or whatever it is, bilateral exchange rates into n minus 1 exchange rates. It's more efficient. But if you look at this system, it's much more efficient than the gold system because you're getting rid of the gold. Okay? Who told us that was a good idea? Adam Smith. Gosh, we don't want to go against Adam Smith. He obviously knew what he was doing. David Ricardo. Well, he's even better. Well, not better than Adam Smith, but just as good. Okay, Adam Smith tells us this is the way we should organize the system. Okay, why in the world did we end up with this crazy system that we've got now? Okay, if we had another 2 hours, I could explain that to you. Okay, but the conditions are there. That is, the blockchain does it. Okay, the blockchain is a waste of time, basically. Okay, it does virtually nothing for anybody that's useful. Okay, every investment that has tried to set up a private sector application of blockchain, aside from crypto, okay, has closed them down because it provides no net benefit. In this particular case, if you're trying to set up a global distributed ledger, well, that's something it could do. Okay, and it's there. People know how to do it. Okay. Now, whether it's the most efficient way of doing that one or not, I don't know. But at least it gives you the idea that you do have the technology. Whereas if you had done this sort of global clearing business in the 1940s, it would have been a logistical nightmare. Now, probably not so much. I mean, Bitcoin still manages to track all of these transactions, and Ethereum does it as well, and different other tokens manage to do it. At least the ones that are not crooked and they take your money away and leave. But for the ones that are legitimate, they do that. The difficulty is that if you take something like Bitcoin, and we don't want to get ahead of ourselves, but Bitcoin basically was meant to substitute gold. And we're saying, no, we don't need to substitute gold. You don't understand. The benefit of having these digital systems is not to substitute for the physical commodity with a digital commodity. What you're doing is you're substituting the payments, the entire payment system. Okay? And you could do that. But as we know, unfortunately, Nakamoto or whoever he was or whatever he was, thought he was building a system so that you could buy swords when you're doing Dungeons and Dragons and things like that. He was looking for small change on the internet so you could buy stuff with tokens. Well, okay, fine. All right. So, my argument would be that the changes eventually are going to come. They're probably not going to be the ideal ones. Okay. I mean, I've mentioned this WebTel system. WebTel Mobi ends up displacing all of the private banks, which technically it could do, is, not guaranteed. Obviously, it's a much more efficient system. It's a much more efficient than the system that we have. But we already know that new technology is not always used in the way that it provides the most efficient outcomes. And basically, this is because when you're using new technology, because we have this defect, and the defect is the one that you've just mentioned, is that, oh man, we can't change anything that we've got. What you try to do is to replicate the system with the new technology. Well, that's not where the major benefit is. The new technology provides an alternative or a different system that is more efficient. And you have to get around to changing that system. And it's not, you have these standard, Brian, what's his name? The guy who invented the argument about the typewriters. Okay, why do we have typewriters that have the letters set up like that, QWERTY, across the top? For English and French have a different one. Well, they're that way because the guy who designed the keyboard was trying to make sure that the individual keys that were in the manual typewriters, okay, didn't get stuck. Okay. So you place the letters and you place the keys and you place the keys on the tablet so that if you're typing the normal words, okay, and we know the normal words have what? Well, if you're a cryptologist, you know that E's arrive more frequently than U's, and you know that T's eventually are designed together with H's. So you want to make sure that those combinations, okay, are not too close to each other because they're going to be struck very rapidly one after the other, and they're probably going to run into each other on the in the basin of the keys. Okay, so that's why you've got a QWERTY keyboard. But we don't have that system anymore. But we've still got the same keyboard. Okay, we still got the technology. We can have an electronic keyboard, or you can have a Bluetooth keyboard, or you can have any kind of keyboard you want, but it's still a QWERTY keyboard. Why? Because that's the way it started out, and this is the confirmation of your question. Yeah, there's some things that you simply can't change. Inertia is too great. Okay, too many people know how to type with QWERTY keyboards, so that if you changed it, and they tried to do this, somebody did design a more efficient keyboard so that you would type more rapidly. That is, so you could put the T's and the H's together and all of these things very quickly. Failed, totally failed. Apple tried it for a while, Apple had this split keyboard. It was split into two halves, and the letters were all displaced. Why? Because people had to learn a different way of doing it. Okay, the sunk costs were too great, and the thing failed. So I say this is the best non-answer that I could give you. That I have faith that eventually, yes, the system is going to change. It's not going to be the crypto system that we've got, may or may not be the WebTel system that we've got, but it is going to be a system because the technology is there. And eventually, the private sector, if it does it, I mean, if you look at this, the WebTel system. Okay, the WebTel system gives you bank transfers virtually instantaneously at virtually zero cost. Okay, now eventually that's going to be a much better deal than going through a bank. Okay, the banks are always going to be charging you more. The banks are always going to be slower because they're not using the technology. So eventually what will happen? Well, maybe the banks will buy this system. Okay, it's a private sector system. They could do that. Maybe the governments could buy it. Okay, but eventually the fact that you do have out there a use case for this particular model says that eventually, if it is more efficient, either it's going to displace the current system, or you can do what the automobile manufacturers did for a while. You buy up the technology and you bury it. Because if the new technology gives a heads up to somebody else, you want to get rid of it. So you buy it and bury it. Or you do what Facebook does. You buy up everything you can in order to make sure that nobody competes with you. Okay, the worst thing that ever happened to Facebook was what? TikTok. And the problem is they can't buy it because the government won't let them. They would be perfectly happy to do so. They would do it in an instant. Okay, somebody else had it. You had another question or somebody else had one? Yeah.
It's important the question because we were talking yesterday about the political issues, and I think it's again in front of us this kind of arrangement between governments like Argentina and Brazil to make these transfers and avoiding to use dollar probably could be an example of what you said. No, so I think we are again on the political lands. But I have a question about the role of the banking system, as we already noted, because what you say about this BTS, CBDS uh, system, it's it's a lot of information to process, by the way. But I can say now that if we talk about this CBDS system in a global system, when we can afford to different countries to make transactions and as you said, matching debit and credits. But what about the banking system? They are is it profitable for them? And well, because if they provide us the account to receive the amount of resources that we I don't know exchange in global, uh, is that good for them? I think it's better because probably we can avoid a cost. But what would say they? I don't know if is it possible.
Well, the simple answer is that if you go back 50, 60 years, okay, basically when I grew up as a kid, banks made most of their money on net interest margins. Okay. They had liabilities that they issued. Okay. There was a government regulation which said that they couldn't charge interest on those accounts. You paid for services. There was a service charge on your checking account, and they charged interest rates on loans. So it was the difference between a very low rate on the that was not paid on the liabilities on the checking accounts, deposit accounts, and the higher rate that they charged on lending. Okay. Now, obviously, if you're not creating money, and the reason that this worked is that that net interest margin increased profits because you could always increase the amount of deposits by expanding the amount of loans. You were expanding your own balance sheet. Okay. Now, if somebody else can do that, okay, it's a threat to your bottom line. And when in the 1970s and the 1980s you had the big push for deregulation of the financial system, it said that the deposit banks no longer had a monopoly and other types of financial institutions could provide transaction services. So what happened? Well, the banks lobbied in order to get the regulations reduced, and they started to shift their profit source. The profit source went from what? Went from net interest margin that, as I said, at one point was something like 70, 75, 80% of revenues. It went down to something less than 50, 45, 50%. The rest of it came from where? Fees and commissions and proprietary trading. Proprietary trading is what? It's simply a guy on a desk speculating. Okay, and this is eventually what came to be called financialization. Financialization was the fact that you simply used financial transactions to generate profitability. Okay, so this is the way. This is the way the system developed. Now, if we take the possibility that all transaction services and all lending services are going to be generated by means of some sort of multilateral clearing system, what happens? Net interest margins disappear. So this trend, which has been going on forever, keeps going and it runs down, basically runs down to zero. Okay? If you know anything about famous P2P loan platforms, P2P loan platforms do what? They say, under the period when central banks had zero interest rates, the ZIRP policy, I had an account which paid me what, maybe 15, 20 basis points. I had money to lend. There were people who wanted to borrow. They could not find borrowers. So we hooked up on the net and I said, I'll lend you the money and you lend me an interest rate which I find acceptable. This was P2P lending. And eventually you had platforms and things that were set up. If you had, I can't remember, I think it was $600,000. If you had $600,000, you could buy all of the software and hardware that was required to set up a P2P lending platform. So I'm lending you money privately, directly, one-to-one. The platform intermediary takes a fee on setting it up, and that was it. What did the banks do? They went, oh boy, this is not good. So what did they start doing? They started buying up packages of the private P2P loans that the platforms were financing. Okay, so they hit back. They didn't try to stop it. They simply said, well, if we're going to let the platforms do basically due diligence and the paperwork, that's fine, because the biggest charges that banks have is doing due diligence and doing paperwork. So we let the platforms do that. We'll buy the loans. We'll take the percentage on it, and we're more or less happy. In this case, they're not going to be happy because it's going to disappear. Okay, so they're going to fight back, just as they fought back in Bretton Woods. Okay, bankers as organized interest groups fought against the introduction of Bretton Woods. Why? Well, there was a very famous book written by Paul Einzig, in which he said, well, if people actually introduce this clearing system, all of those bankers that deal in international finance are going to disappear. Why? Because you can't get to the international finance, okay? These are debits and credits that are in government institutions, okay? There's no debit and credit of a private individual that exists. If you've got, you're a private individual, you have to pay something to somebody. Who do? You pay not to a bank, you pay to that agency, that clearing fund. And they say, well, suddenly all of that international finance business is going to disappear. And the international bankers went bananas. They had people in Congress every day, night, morning, night, noon, night, evening, night, every minute of the day, arguing that this was going to lead to the collapse of the international financial system, or else it was going to lead to rampant inflation because there was no control over the lending. Okay, so yeah, I mean, you have to realize that there is a threat to this. But if you look at what the central banks are doing, they're sort of slicing the melon in half. They're saying, okay, we're going to do the digital thing. We're going to have digital deposits. But the public can't get those digital deposits. The private banks are still going to be the intermediaries by which the public accesses those digital deposits. Okay, so just as the thing works today, if you want a banknote, you have to go to the bank to get it. You have to have a deposit in the bank. If you want a digital deposit in the central bank, you have to have a bank account to get it. So the banks are still going to keep their control, more or less their control of the system. So they're now going to be doing what? Well, they're going to be borrowing and lending CBDC between their clients and other clients, and they're going to use these as the reserves with the central bank. Now, this is not really what originally people had in mind, because the argument is that it would have been quite simple for everybody. I don't know, everybody has a national insurance number, a social security number, or an ID number, or whatever in every country in the world. I mean, there's not one in which you don't have some sort of national identifier. You turn that national identifier into an account in the central bank, and you're done. That's it. You don't need the banks anymore. Okay. If they want to have a credit card, okay, that's fine, but they can do it on their phone. If they don't like doing it on their phone, they can do it on their computer. If they don't like doing it on the computer, well, that is a problem. Okay, we'll deal with that. We'll talk about that tomorrow. And this is one of the difficulties with crypto. Okay, there are barriers to entry to crypto. There are barriers to entry to digital systems, which can be very high in certain segments of the population. And on the other hand, there are risks. Okay. Now, it used to be the case where the risks were just, well, if you lived in some part of the country where you had lots of fires, or you had lots of wind, or you had lots of snow, the electricity system would occasionally go down. The electricity system goes down, and well, you're as good as bankrupt. Now, what can you do? Can't do anything. You can't buy anything. You can't sell anything. Can't pay for a cab ride. You can't, nothing. Okay. This used to be the case in digital. In crypto, you had this problem of the wallets. Everybody had a wallet on a CeFi exchange, and then all of a sudden you discover that having a wallet on the CeFi exchange, no, you could not have a wallet on the CeFi exchange. They could disappear. So now everybody's got cold wallets. But even if you've got cold wallets and the electricity goes down, it doesn't help you. Okay, you've got your cold wallet, it's there. You've got all your crypto and your cold wallet, but unless you can get that computer to work, or your phone to work, or something to work, you're nowhere. Okay, so this is the basic problem that you've got with these systems. I mean, they look great. As I said, I'm still very skeptical about this system. I mean, I live in a part of the country north of New York City. Okay, we get we used to get a lot of snowstorms, a lot of ice storms, a lot of windstorms. Okay, I've got a temporary generator behind the house because the main electricity goes off at least 10 or 15 times a year. And this is irritating. Okay, it's irritating, if you want to do sort of just natural, normal stuff. If you want hot water, or you want to take a bath, or you want to do something like that. If suddenly that's, your currency is in fact part of that energy system, and we're now in a system in which that energy system looks like it's breaking down, then there are going to be introductory problems. All right. So what I would argue, if you hear somebody like me who says, okay, we've got the technology, we can do this, blah, blah, blah. You say, well, okay, yeah, we do, but do we really? Okay, do we really have a sufficiently stable grid to allow this thing to function? And you say, well, we have solar panels and we have solar batteries. And you say, well, okay, yeah, that's one possible solution. Everybody's got a solar panel and everybody's got a good lithium battery, and you've stored up enough juice in the battery that if the mains go down, you can still function, you can still operate. This is what you call the fail-safe on the system. It's conceivable, but it's not going to happen tomorrow. And again, this is a barrier to entry to the system. Okay, you get a bank account, you walk into the bank, and that's it. More or less, you pay so much a month if you don't get some sort of special agreement. But if you've got to buy your solar panels and you've got to buy your lithium battery and you've got to buy all of that stuff just in order to have money, okay, that's not the way the thing normally works. It's not going to be that easy. So, we're again back to this case. You have positives and negatives to these things. They give you advantages, they give you disadvantages. And all you can do is to try and identify as best you can what they are on both sides. But to predict what eventually is going to happen, as I said before, this is basically the Schumpeterian deal. Okay, it's the innovators and the technology which is eventually going to dominate. Okay, and those are things which are impossible to predict. And it's an interesting exercise. If you look at most technical innovations, you find that the places in which they were originally introduced are not the places at which they were successful. They were eventually abandoned and were readapted by creating some alternative method of using the technology. Okay, so we have we sort of have this implicit bias, which says, oh, you get new technology that says, we're going to be able to do things, the same things we did before. We're going to be able to do them better. Okay, you get cars and you manage to get rid of horses and you get rid of the shit in the streets. Okay, fine. That's one thing that new technology did. But until you got roads and until you got other types of support systems in order to provide integrated transportation systems, that new technology simply replacing horses, that was not the biggest benefit that the thing that it produced for you. So that's the sort of problem that you have in predicting. And if you look at the expert, and I mean, I'm not an expert on technological implementation, but if you look at the experts on implementation, this is what they'll always tell you, is that first of all, you have no idea in predicting what technologies are going to be the most successful, and you have no idea of predicting how that new technology is going to have an impact on the system. I mean, if we think, you think back, I still remember 78 RPM records, and then we had LPs, and then we had CDs, and then we had MP3s and MP4s, and nobody said, gosh, we're not going to give up those 78 RPM things because, it's tough to do that. But interestingly enough, the LPs are coming back. All of those things I've got in my closet are now worth a fortune. They're probably worth more than my pension fund. Yeah, I'm ready to quit when you stop asking questions. That's all.